Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we're solving the very first case study question of your section C of the FM pre-June exam. So this is a question on investment appraisal. The name of the company is Nunda stores, and I can see the requirements first. Like I always tell you, when it comes to a section C question, you're always supposed to read the requirements first before you move to the case study. So as far as the requirement is concerned, I'm supposed to find out the NPV, the IRR, the payback period, as well as the ROCE or the ARR based on the average investment. So these are all of the requirements which I have at the moment, and this is the case study. So let's delve deeper into the case study now. Nanda Stores is a community-based supermarket that works with local suppliers to bring their produce to the market. It is expanding its operations and is considering setting up 10 stores in the south of its country. The directors are concerned that the payback on the investment will be a long period, but are confident that this expansion will be profitable and it will show positive return to the shareholders. The directors normally have a target payback period of 2.5 years and a target return on capital employed of 25% for investment. So these are what their targets look like. The finance director has suggested she provides NPV and IRR calculations for this investment. This will enable all directors to see a full picture of the investment's potential financial acceptability. This expansion is going to cost $330 million paid at the start of the first year. As reinvestment in stores will be required for every 4 years, the company evaluates investments over a 4-year time horizon and assumes a nil realizable value. Working capital should be ignored as this is a cash-rich business with a negative cash operating cycle. Nanda Stores has prepared the following forecast of contribution and incremental fixed costs at current prices of the 10-store program over the 4 years. Inflation is estimated to be 4% applicable on your contribution and 3% applicable on your fixed costs. Nanda Stores pays corporation tax of 20% per year, 1 year in arrears, which straight away means that the money that I'm earning, the profits that I'm making in the first year, the tax on which I will be paying in the second year's profits taxed in the third year, and so on. With 25% straight tax allowable depreciation available on the investment expenditure, Nanda currently uses 10% as the nominal after-tax discount rate to appraise the investments. So without any further ado, let's get started. This is the first part wherein we are trying to work out the NPV for 5 marks. So I will mention that this is my answer to requirement A, and first part of that requirement, this is the net present value. So number 1, I'm going to put in all of the years, year 0, 1, 2, 3, 4, and we'll also need year 5 because the tax on the profits of year 4 will actually be paid out in year 5. So the first thing that I have is the contribution, which is given to me in terms of $1 million. So I have 2 options. Either I take every calculation in terms of $1 million, or I take the entire calculation in terms of all of the zeros. So instead of putting all of the zeros, I'm going to do my calculation in terms of millions of dollars. So firstly, I'm going to have my contribution. Contribution for the first year is given to us as 80 million. So 80 multiplied by the inflation rate as well. So it is mentioned that the inflation will be applicable 4% on your contribution. So multiplied by 1.04 raised to the power of the year, which is year 1. So 83.2 is going to be your contribution in the first year. In the second year, similarly, it is 160 multiplied by 1.04 raised to the power of the year. So this is what your contribution is going to look like in the second year. In the third year, it's 180 multiplied by 1.04 raised to the power of the year. And then similarly, doing it for the last year as well, I will take 200 multiplied by 1.04 raise it to the power of the year, which is 4. So these are all of my contribution figures for the 4 years of the project life. So this is a better way of presenting. I have put it to 2 decimal places only. Now the next thing that I need to take is subtract my fixed costs. My fixed costs are going to look something like this, equal to 50 multiplied by the inflation. Inflation on fixed cost is given to you as 3%. So multiplied by 1.03 raised to the power of the year again. So this is what your fixed cost is going to look like. Similarly, if you want to have a faster way, you can copy paste the figures, but make sure that you are changing the fixed cost that is given according to the question. But over here, it is 50, so it does not matter. 50 for all of the years, and inflation being taken by the year itself. So this is how you have arrived at your inflated fixed cost. Now, the next thing that I get is nothing but my operating cash flows. So my cash flows is this figure plus this figure. So the net difference that I get in the contribution and fixed cost is what my contribution actually looks like. Now I will be charging for tax. So let's apply for tax at the rate of 20%. And this is paid a year in arrears, which means the money which I've earned, the profits that I've made in first year, I'm going to pay the tax on them in the second year. So equals to, you can put a negative sign because tax is going to be an outflow. 20% is the tax rate. Similarly, if you just drag this to the rest of the cells, you will have your tax payments for the rest of the years also. So this is what your tax payments are going to look like. Now we have taken contribution, we've taken fixed costs, we've taken for tax. The next thing that I need to take is for the tax allowable depreciation. So let us head to a working note. We can do the workings on the side here. This is for the tax allowable depreciation. Now over here it is mentioned that your tax allowable depreciation is going to be 25% straight line on the available investment expenditure. Over here your investment expenditure is $330 million. So on this you're going to have 4 years. So basically 25% is the straight line depreciation that is allowed. So every year it's going to remain the same. It's going to be equal to 330 multiplied by the depreciation rate, which is 25%. So every year, this is going to be the depreciation that is going to be allowed, and then the benefit is going to be 20% of this value. So this is the amount of benefit that you're getting each year. Now, because your taxes are being paid 1 year in arrears, you will also be getting the benefit 1 year in arrears. So 16.5 is going to be a positive figure in all of these years. You can just all right. So these are your tax allowable depreciation benefit for all of the years. Now we are more or less done with everything. We just have to take our initial investment. So initial investment goes out in year 0. Start of the first year basically means right now. So year 0, you have an initial investment of minus 330, showing it as a negative figure because it is money going out. So let us work out the total cash flows over here. Total cash flows are going to be the sum from operating cash flows tax to the initial investment. So you just copy paste this formula to the remainder and you will have your answers. These are your total cash flows. This is what your total cash flow is going to look like. 330 for the year 0, 31.7, 130, and then 140, and then 164, and then a negative 19. So this is what your cash flows are going to look like. Then the next thing that you're supposed to do is you need to discount them. So we will very well use the NPV formula, which ACCA platform has. So simply take NPV equals to, use the discount rate first, which is given to you as 10%. Apply it from year 1 to 5. And then you manually add for the initial investment. I'm adding it because it's already shown as a negative figure over here. So it does the job of, actually subtracting it for me. So this is my final NPV. I can possibly choose this format, or maybe if I want some more decimal places, $12.46 million is what my NPV is going to look like. So with this, I am done with the first part for 5 marks. Now let us move towards the internal rate of return for 2 marks. This is fairly simple. I just need to put the IRR formula to my above calculations. Equals to IRR, select all of the figures, hit enter, and you have your IRR. So convert it to percentage, because IRR is always quoted in percentage terms. 11.48 is what it's going to look like. Then let us move towards the payback period. This was, you can mention that this was part 2 over here. You can also bold your calculations, just so that we have a little bit of space between both the parts. Right. Now let us move towards the third requirement. Third requirement, which has asked us to calculate the payback period. Payback period, because nothing is mentioned that which one should I be using, so I will be calculating the simple payback period. So in year 0, I'm actually having an outflow. My outflow is minus 330, and if I see my inflows I have right over here. These are what my inflows look like. Okay, so I will have to manually bring all of my inflows. This is the third year, and this is the fourth year, and this is the fifth year. So these are my total cash flows. I can say that these are my total inflows. Now my payback will be the time when I've actually recovered this entire 330. So if I say that in the first year, I've actually been able to recover 31.7, then how much am I left more with to recover? So I can just keep adding the cash flows that I have. Now, after the first year, basically I'm left with 298 million more to recover. So to this, if I add what I'm getting in the second year, now I'm left with 168 million more to recover. Now with the third year's inflows, I will also recover a lot of my money. Now only 27.79 is what is left to recover. So this is the money that I need, and this is the money that I'll be getting in the fourth year. So I know that my payback is 3 years plus some portion of the fourth year. So let me see how much proportion of the fourth year. So this much is the money that I need versus this is the money that I will be getting. So roughly it is 0.17 years. So I can give my answer as 3 years plus 1.7. Basically 3 plus 3.17 years is the payback period. This is your third part solved. Now let us move towards the very last part, which is return on capital employed. Please make sure that you observe it is based on the average investment that you have to do this calculation. So you can even highlight this as your answer over here, that this is the payback period. All right. So we move to the fourth part, over which we have to calculate the ROCE. So for ROCE, the very first thing that I require is going to be my average investment. So my average investment is nothing but the opening plus closing divided by 2. Opening is 330. I do not have any closing investment. So my average investment is nothing but 165, 330 divided by 2. Then the next thing that I need is my numerator. Numerator is supposed to be my PBIT. So what will I be doing over here is, all right, so now I want my profit before tax, or my PBIT, the average one. So what will I do over here is, first I will see how much is my average operating cash flow before tax. So I will bring my figures from above. I will sum them up. It's going to be 31.7. These are my operating cash flows before tax, plus this, plus this, plus this. So till where did we get it? Till the third year. So we'll add the last year as well. These are your cash flows, and then you have to divide that by 4 because you want to find the average annual. So this is what your average annual operating cash flows before tax look like. Then you account for your depreciation. You have subtracted it, so now you will add it back because your PBIT actually has depreciation built into it. So your depreciation is going to be 330 divided by 4. This is what your depreciation looks like. Now, how will you find out your average profits before tax? So profits before tax are going to look like this figure over here minus the depreciation. So this is what your average profits before tax are going to look like. Now, let us put it in the formula. It's nothing but your PBIT divided by your average investment. So your final answer is going to look like 22.3%. Convert it to the percentage format and you have your answer. So this is your final answer of ROCE. All right. So with this, we are done with part A. Let us move towards the next requirement. The next requirement is a 10-marker requirement. It wants you to discuss the suitability of the techniques used in part A for determining whether to take whether to undertake an investment and advise whether Nanda Store's proposed investment is financially acceptable. So over there, back on the previous requirement, we've basically calculated 4 numbers: NPV, IRR, payback, ROCE. So on all of these numbers, we are supposed to comment over here that are the numbers that we have calculated according to that. Is this investment good or not? So firstly, you're going to be explaining what NPV, IRR, payback, and your ROCE actually tell you. First, you will be explaining that because this is a 10-marker requirement. You first need to explain what these methods tell you, and then you will compare it with the target and discuss about the financial acceptability. Now, as far as the NPV is concerned, firstly, you're going to started with the discussion that NPV essentially uses cash flows rather than profits. And, just the definition that we take into account the time value of money, and it is an absolute measure. It tells you how much the shareholders' wealth is going to increase by. Cost of capital is taken into account, the 10% that we have taken. So according to our answer in the previous part, the NPV which we worked out was 12.4. Yeah, 12.4 million. So this is what the NPV is looking like. So you will say over here, 12.4 million is a positive NPV. Hence, we should be going ahead with the project. This much will be the absolute increase in the wealth of the shareholders if we actually go ahead. So according to the NPV method, the proposed investment is in fact financially acceptable. Then if we talk about the IRR, firstly, you will theoretically explain it and then you will compare it with the answer that we have gotten. IRR we have gotten as 11.48%. Firstly, you will start with the discussion of IRR. IRR basically is a method which takes into account time value of money, tells you the rate at which NPV will be 0, tells you exactly how much is the internal rate of return that your project is generating. So IRR, but also let them know that it is a relative measure. It does not tell you how much the wealth of the shareholders is going to increase by. So you should rather go for those projects which give you a higher absolute value. So then you will tell that the IRR which we have calculated over here is roughly 11.5%, which if you compare with the target that they have given, They do not have any target, but if you compare it with the cost of capital is given as 10%. So this IRR is 1.5% higher than your cost of capital, which means that your return is more than what is required. So this through the IRR method also, your project remains acceptable. Then let's talk about the payback period. The payback period which we have calculated previously was a little bit more than 3 years, 3.17 if I remember that correctly. 3.17 was what we had gotten, and according to the target that they have a target payback period of 2.5 years. So it does exceed 2.5, but at the same time you will also leave a discussion with payback that payback has a higher advantage because it takes into account the cash flows, but again it ignores the future cash flows that happen after the payback. So the managers, which they have set a target payback period of 2.5 years, and the payback for the project is actually 3.17 years. So even though this exceeds the target, but still it may be an acceptable project because of the overall NPV and IRR giving you a favorable place. So talking about ROCE, again, you will start off with a discussion that ROCE reflects how much is going to be the return that the shareholders are going to be getting on their investments. So, but you will also comment over here that ROCE does not take into fact the time value of money. So if you see the target which they have is 25%, but the ROCE which we have calculated, let's see, that is 22.31%, which is lesser than what the managers have targeted. 22% is what we have gotten, 22.3%, and 25% is what the management's target looks like. So it is below their target. And then once you have commented on all of these 4 indicators, you will also leave an overall conclusion. Overall conclusion, you will say that using the NPV and IRR methods, which are good methods of evaluating investments, we are getting an accept decision rule. So, if the managers actually can go on to do probably a sensitivity analysis and, find out that it is based on the management's decision that they should be, the investment ideally is acceptable using 2 of the 4 methods. So if the payback and, the 3% ROCE target, that is something the directors have set, maybe if they are very sure about their targets, or if they could tweak their targets a little bit to adjust for this, investment, then they could go ahead with the investment. And in the long term, it's definitely going to give you an increase of $12.4 million in your shareholders' wealth. So with this, we have come to an end to this question. In the next video, we will be solving Lottery Company. I hope that this was useful. Thank you so much for watching.